Today we're tackling a massive and honestly, a bit of a controversial topic in the world of personal finance: financial advisors. Specifically, we're going to talk about that notorious 1% fee and whether you're really getting your money's worth. We're going to build what I call the advisor-proof portfolio, a strategy designed to help you build serious wealth without handing over a significant chunk of it every single year. So let's start with the big question. What is that 1% fee, and what does it actually cost you? 1% might not sound like a lot. If you have $100,000 invested, it's $1,000 a year. But the real damage isn't the $1,000 today. It's the compounding growth you lose over decades. Let's run some numbers. Imagine you invest that same $100,000 and it grows at an average of 7% per year. After 30 years, without any fees, it would grow to over $760,000. Now, let's add that 1% fee. That fee doesn't just come out of your initial investment. It comes out every single year, reducing your effective return to 6%. So after 30 years, your portfolio would only be worth about $574,000. That 1% fee didn't just cost you $30,000 over 30 years. It cost you nearly $190,000 in lost growth. That is the insidious, hidden cost of that seemingly small fee. It's a massive drag on your journey to financial independence. So, why do so many people pay it? Well, the traditional wealth management industry is built on a few key ideas. First, the idea of expertise. They position themselves as the gatekeepers of complex financial knowledge, making investing seem like rocket science that the average person couldn't possibly understand. Second, they sell convenience and peace of mind. They handle everything so you don't have to worry. And third, they often sell the promise of beating the market, using their special skills to pick winning stocks and generate outsized returns. But here's the reality check. Decades of data have shown that the vast majority of active fund managers, the very people trying to beat the market, fail to do so over the long term. In fact, most of them underperform simple, low-cost index funds. So you're often paying a premium for a service that delivers subpar results. You're paying for the illusion of security, not necessarily for better performance. This brings us to the core of our advisor-proof portfolio. The goal is not to become a Wall Street trader glued to your screen all day. The goal is to build a simple, effective, and most importantly, low-cost system that works for you automatically. The philosophy is based on a few key principles. First, we accept that we can't consistently beat the market, so we aim to be the market. Second, we prioritize keeping costs as low as humanly possible because costs are one of the few things in investing we can actually control. And third, we focus on a long-term diversified strategy that we can stick with through thick and thin. This isn't about getting rich quick, it's about getting rich for sure. So, how do we build this thing? The foundation of our portfolio will be built on low-cost broad market index funds or ETFs. What are these? An index fund is a type of mutual fund or exchange-traded fund, an ETF, that aims to track the performance of a specific market index, like the S&P 500. Instead of trying to pick individual winning stocks, you're buying a tiny piece of every company in that index. For example, by buying an S&P 500 index fund, you're instantly invested in 500 of the largest companies in the United States. This gives you instant diversification. If one company does poorly, it has a minimal impact on your overall portfolio because you own 499 others. The beauty of this is its simplicity and its incredibly low cost. The expense ratios for these funds are often hundredths of a percent, not a full 1%. We're talking fees like 0.03% or 0.04%. That is a massive, massive difference. Let's get practical and design a sample portfolio. A classic and highly effective model is the three-fund portfolio, popularized by the Bogleheads community, followers of the late Jack Bogle, founder of Vanguard. This portfolio consists of just 3 funds. First, a U.S. Total Stock Market Index Fund. This gives you exposure to the entire U.S. stock market, large, mid-size, and small companies. Second, an International Total Stock Market Index Fund. This diversifies your holdings beyond the U.S., investing in thousands of companies across developed and emerging markets around the world. Why is this important? Because no single country's market is guaranteed to be the best performer forever. Global diversification protects you from that risk. And the third component is a total bond market index fund. Bonds are generally less volatile than stocks and provide stability to your portfolio. During a stock market downturn, your bonds will likely hold their value or even go up, acting as a crucial cushion. Now, the allocation, or the percentage you put into each of these funds, is personal. It depends on your age, your risk tolerance, and your time horizon. A common rule of thumb for your stock allocation is 110 or 120 minus your age. So, if you're 30 years old, you might have 80 to 90% of your portfolio in stocks, split between U.S. and international, and the remaining 10 to 20% in bonds. As you get older and closer to retirement, you'd gradually shift more of your portfolio into the safety of bonds. For example, someone who is 60 might have 50% in stocks and 50% in bonds. This is your asset allocation, and it's the single most important decision you will make. It has a far greater impact on your long-term returns than trying to pick the next big stock. Okay, so you've chosen your funds and your allocation. What's next? The magic word is automation. You can set this entire system up to run on autopilot. Open an account with a low-cost brokerage firm like Vanguard, Fidelity, or Charles Schwab. All of them offer their own versions of these low-cost index funds. Then, you set up automatic contributions from your bank account every single month or every payday. This is a strategy called dollar-cost averaging. You're investing a fixed amount of money at regular intervals, regardless of what the market is doing. When the market is high, your fixed amount buys fewer shares. When the market is low and prices are on sale, that same fixed amount buys more shares. This removes emotion from the equation. You're not trying to time the market, you're just consistently buying. The final piece of the puzzle is rebalancing. Over time, because stocks tend to grow faster than bonds, your original asset allocation will drift. That 90-10 stock-to-bond portfolio might become 92-8. Once a year, or maybe twice a year, you simply log in and sell a little bit of what has done well and buy a little bit of what has lagged to bring your portfolio back to its target allocation. This is a disciplined way of selling high and buying low, and it takes all of 5 minutes. And that's it. That is the entire strategy. You choose your allocation, you automate your contributions, and you rebalance periodically. No high fees, no complex products, no market timing anxiety. Now, I know some of you might be thinking, is that really it? It sounds too simple. And that's the beauty of it. The financial industry profits from complexity. They want you to believe that you need them. But decades of evidence and the success of millions of everyday investors prove that a simple, disciplined, low-cost approach is the most reliable path to building wealth. By cutting out that 1% fee, you are adding rocket fuel to your investments. You are reclaiming control of your financial future. This isn't about being anti-advisor for everyone. Some people with extremely complex financial situations like intricate tax planning or estate issues might benefit from a fee-only planner. But for the vast majority of people focused on long-term wealth accumulation, the advisor-proof portfolio is not just an alternative, it's a superior strategy. You are fully capable of managing your own investments and achieving financial independence. It just takes a little bit of initial education, like what you're getting right now, and the discipline to stick with the plan. Don't let anyone tell you it's too complicated. Take these principles, do a little more research on the 3-fund portfolio, and start building your own advisor-proof future. Thank you so much for watching. If you found this video helpful, please hit that like button and consider subscribing for more content that empowers you to take control of your finances. Let me know in the comments if you have any questions or if you're already using a similar strategy. See you in the next video.